Welcome to Greystone Capital Group, where we invite you to embark on an extraordinary journey towards a life of abundance and fulfillment. At Greystone Capital Group, we specialize in the transformative power of passive investing in commercial real estate. Your journey to financial freedom and a fulfilled life begins right here. Subscribe now and let Greystone Capital Group be your guide to shaping a brighter tomorrow.
Hello, welcome to the show, everyone. Today I have a special guest and an honor to meet Mr. Neal Bawa. I've seen you on stage several times. I'm very happy you're on my podcast, and it's an honor for you to come be here.
Thanks for having me.
Okay. Neal Bawa is a technologist who's universally known in real estate circles as the mad scientist of multifamily. He's one of the most in-demand speakers in commercial real estate, and he's a data guru, a process freak, and an outsourcing expert. Neal treats his $700 million multifamily portfolio as an ongoing experiment in his efficiency and optimization. The mad scientist lives by two mantras. The first one is, we can only manage what we can measure. And the second mantra is, data beats gut feeling by a million miles. So these mantras and a dozen other beliefs drives his profits for 1,000+ investors. So wow, that's a great philosophy you have for these two mantras. And the first time I heard about them, were reading your background. So welcome, Neal. Thank you.
Well, thanks for having me and looking forward to the conversation.
Great, great. So today we just want to kind of understand in the multifamily world investing. I know it's been very challenging to find good deals in the past maybe year or so, and also the interest rates went up significantly in the past 1 or 2 years. So what are your take on that, Neal, for us who's looking to invest and buy multifamily? What's your insight on that?
So, when you're looking to invest in multifamily, whether you're a passive investor or a general partner, it's very important to understand market cycles and important to understand where you are in the market cycle.
Yeah.
If my focus was, oh my God, I'm looking at what's happened in the last 2 years, I'm going to make no investments in multifamily today or probably even a year from now, because I'm looking at the past. And that is the viewpoint of most investors. But understand that when you make an investment based solely on what's happened in the last 12 months or 24 months, especially if those last 24 months have been unusual, you're not an investor, Jonathan, you're a speculator. Speculators look at recent data and say, oh my God, this stock fell, I need to sell, right?
Yeah.
That's not the way investors, especially big investors like the superstar investors invest that way, right?
Okay.
So like Warren Buffett. The last 24 months have been very challenging. And actually today and the next 36 months represent an opportunity because of the fact that the last 24 months have been challenging, right?
Yes.
So I want everyone to remember what was happening in 2008. 2008, stock market's crashing, all these companies on the famous big stock market companies are going out of business, and real estate prices are crashing. Nobody knows where the bottom is going to be. Nobody knows what prices should be at. And prices have crashed and crashed and crashed and gone down so much in the last 6 months that people are like, where are they going to end? Most investors at that point didn't buy real estate. In fact, if anything, it was a joke that if you want to lose money, buy real estate. But people who understand that distress creates opportunity, that problems create opportunity, people like me, we were very happy, very, very happy that others felt that it was the wrong time to buy real estate because it allowed us to buy. During that time frame, I was buying one property every month for 3 years for myself, my sister-in-law, my mother-in-law, anybody I could really find a property for that was related to me. And those properties have all quadrupled, and I've already had millions of dollars in income from those properties. So for me, I sort of like the fact that investors are afraid, because it sort of makes it easier to make money.
Yeah.
So today's environment is still challenging. I'm not saying that you can buy a property and make money. It's not like 2008 where I felt like any property that I could buy would make money, because in 2008 we had low interest rates, right? So interest rates were down. Today we have high interest rates, But what we do have is a significant decline in prices over the last 24 months for multifamily, not for single family. In fact, single family prices in the last 24 months are up about 6%.
Wow.
So single family is in a bubble because interest rates have doubled, right? The average mortgage payment for Americans is up 111% since COVID, but their incomes are only up 19.7%. So your mortgage goes up 111%, your income only goes up 19%. That's the definition of a bubble. So single family is currently in a bubble. And you can't hold a gun to my head to buy a single family rental at this point of time because I think the prices are too high. And we're beginning to see some adjustments now. We're beginning to see prices fall in certain parts of the US, like Austin. So that process has started, but it's certainly the prices are too high. Multifamily is a business. I mean, it's not an emotional decision. And so what has happened is in a very smooth fashion, since the peak of multifamily, which was March 2022 to now, about almost 2.5 years later, prices have smoothly declined on a cap rate basis, not on a per door basis, on a cap rate basis, they've declined. And depending upon who you ask, there's a 150 basis point increase in cap rates, which is roughly a 25% decrease in prices. And so today, prices are 25% lower than they were 2 years ago. But investors are not willing to buy because they're seeing the price decline as a bad thing. Whereas an investor, I see price declines as a good thing because my basis is lower, because interest rates change. I can always go back and refinance a property. So I have the ability to benefit from a decline in interest rates in the future, even if I'm locked in, even if I have a fixed loan and I'm locked in. Well, 4 years, 5 years from now, if rates are much lower, I can sell my property for a much higher price because lower rates mean higher prices. Remember, higher rates meant lower prices.
Yes.
Therefore, whenever it is that rates go down 2 years, 3 years, 4 years, 5 years from now, we will see higher prices. So even if I'm locked in on an interest rate today, I can still sell my property then and pay a defeasance fee. So it's a fee that you pay to your bank for breaking a fixed loan. And each year that goes by, that fee drops. So buying cheap is the most critical thing. And today you're buying cheap. I do not believe that the prices of multifamily that we are seeing today or in the remaining of 2024 will be available to us in 25 or 26, especially not 26, because of supply challenges that the US is going to face in 2026. And we'll talk about that separately. But bottom line is that I believe that the prices of multifamily on a cap rate basis are going to go up in 2025 and then go up sharply in 2026. So when you're purchasing today, you're trying to understand the point in the cycle that you're at, and you're trying to not ignore, but set aside what has happened in the last 2 years, because what has happened has already happened.
Yes.
The pain that was already felt has already been felt.
Yes. And let me ask you this and again, know your thoughts. Let's say you have one at a fixed rate, maybe 6.25%, like a Freddie Mac. But what would you do right now is take a bridge loan, temporary, fix up 1 or 2 years, and then refinance. Let's say a 10% rate in a bridge debt, and then do heavy capex and a refinance in 2-3 years. How do you feel about that?
It makes all the sense in the world to take a bridge rate in an environment where interest rates are ready to decline. However, most investors are not happy with that. It's very difficult to raise equity for a floating loan because of what's happened in the last 24 months. So once again, what you should be doing and what you end up doing are often two different things, because you still have to raise equity, and most investors are much more comfortable raising, locking in an interest rate at 6%, which is a high interest rate, than they are, to be on a bridge rate. Also, the bridge floating rates for now are too high. So that's the other challenge, because bridge rates are very high until the Fed at least cuts rates 2 or 3 times. Once the Fed cuts rates 2 or 3 times, you'll see bridge prices go down. You'll see bridge interest rates go down. The spread is too high right now because the Fed needs to cut rates for that spread to start to compress.
And do you expect one rate cut this year? How do you feel about the interest rates?
I think one rate cut at this point of time is pretty much guaranteed, and I'll explain why. So when we look at the economic environment, that's the biggest thing holding the Fed back from cutting rates. People have started to believe some really stupid things, like the Fed doesn't want to cut rates. Such a silly comment. No Fed governor would ever say anything like that or even imply anything like that. The Federal Reserve thinks that the right Fed funds rate is around 2%, maybe 2.5. Okay, they say 2, but maybe they mean 2.5. So let's just use the higher number. Right now, the Fed funds rate is over 5.25, right? So we're 275 basis points or 2.75% from where the Fed thinks the rate should be.
Yeah.
The only thing that's preventing the Feds from dropping rates is inflation, right? And so inflation peaked a little over a year ago at 9.1%, right?
Yeah.
9.1, that was a very high number. But then we managed to get inflation down from 9.1% to about 3 and something very quickly.
Sure.
So it was a very smooth decline. Then from 3, getting it down to 2 has taken us 1 full year. Just, that last percent, and this is very common, economists say this, the last 1%, getting that last 1% down is hard because expectations have changed. People believe that rates are not going to go down. And so it takes a while for that to happen. But now, and that's why the Fed has rates very, very high. They're extraordinarily high. They should not be this high for this kind of environment and this kind of inflation. But pushing that last 1% down takes an extra big hammer. And that's why we have an extra big hammer on the economy right now. And it's working beautifully because if you look at job openings in the US, they were 12 million, then 11, then 10, then 9. Now they're at 8, right? The number of people looking for jobs, around 8. So when there were 8 million people looking and 12 million jobs, you had wage inflation, and that was making the problem worse. We don't have wage inflation in the United States as much anymore. Wage inflation is normalized. So it's in the right place. We had rents that were too high. In 2022, we had 15% increase in rents. And then 2023, it was much lower, but it was still positive. And at 2024, we're just treading water. Maybe rent increases are 0.5%, 1%, whatever number, depending upon the market you're in, but they're very small, very tiny. So rent increases have moderated, and rent and wages are 2 of the biggest components of inflation. Oil has moderated after the war, the shock from the war. Oil is down to below $80 a barrel. And so as a result of all of those, inflation numbers are really low. Inflation is measured in 2 different ways, but the one that the Fed likes is called PCE. PCE. The PCE number that came in a few weeks ago, and we're here in July, and it came in at the beginning of July or end of June, was 0.1% for the last month. It's only for the last month, so I don't want to read too much into it. But if you take the monthly 0.1 number and multiply by 12 months, inflation is now at 1.2%. What's the Fed's target? 2.5. Right? So inflation right now for the last month is lower than the Fed's target. Now, of course, the Fed will want to wait for a few more months to make sure that this trend is sustainable and it doesn't jump back up. They're smart. They're doing the right thing. But so I obviously, I don't think the Fed has to raise rates until September, but I believe that the US economy now is in trouble of going into a recession because everything's slowing. Job growth is slowing. Job losses are increasing. People claiming unemployment is at the highest number since November 2021. So we're slowing pretty aggressively. And so I don't see a scenario at this point where we don't get 1 rate cut this year, most likely in September. I do see a good potential scenario where we get 2 quarter point rate cuts this year. If the economy continues to weaken, we'll get 2. But if it stays sort of where it is now, then we'll get 1.
Okay, because right now I feel from some of my tenants, they're having difficulty paying some of the rent, or they they're late and everything. So I feel that pain from my own tenants. So I can feel that it's tough right now for some of my tenants. So it's great. So
I think that's true all across the board, because what has happened with inflation is, I just want to point this out to you, right? So inflation spiked, and when prices came down, they didn't go negative. They basically stayed where they are, right? So what we've managed to do with inflation is prices went up, and then we managed to put some control over it with interest rates, and the prices have stabilized in certain areas, like rents have stabilized, and other areas have stabilized. New cars are slightly cheaper than last year, but they haven't gone down to where they were before. But tenants incomes have not gone up very much, but then they've had to deal with all the inflation in the last 2 years, and we're still at the top here. We may not be going up any further. We're still at the top, and the tenants' income was here. So that gap means that it's very difficult for tenants to make numbers work.
And we've been talking about in the past, we were saying, hey, the stress is coming. I hear it on on certain events I go to, and I still trying to find the big news of distress apartments where you can get very low bases, but those are very, I guess, yeah, talk with banks or something. How would you, do you see that in your world, or the big distress and the multifamily and the collapse?
I think those are nonsensical words. So the word collapse, the word distress, when you apply it to multifamily, it makes no sense. And here's
Okay.
why.
Okay.
In the last 13 weeks, my team has made about 20 offers, and we have lost all 20. We've
Oh,
only
wow.
gotten into best and final on
Okay.
two out of 20,
See.
and we lost those two in best and final. So we've lost 20 offers out of 20. In every single case, the winning buyer put in hundreds of thousands of dollars down, hard money on day one. Hard
Wow.
money,
Wow.
right? Does that give you a sense of a distressed market? In 2008, when I was bidding on homes that cost $250,000 to bid, and my bid was 90,000, I was the only bidder. There was
Oh,
nobody else.
oh,
Today, there are 15, 20, 25 bids on every decent multifamily property in the United States. How can you possibly equate that with the word distress? There is distress in multifamily, and I will explain roughly what has happened is prices of multifamily have gone down by 25%. If you apply that definition of distress, then owners and landlords are distressed because they're not getting as much value for their property as they needed, especially if they bought it after 2018. So if they bought it in 2016 or 17, they've gained so much value over that time that the fact that values have gone down 25% is not going to bother them at all, right?
okay.
So what is going to bother people are the properties that have been purchased in 2018, 19, 20, 21, 22, and 23, because those properties have lost value. And that loss of value means many investors have their equity is wiped out or close to non-existent. And if they continue to hold on to these properties for the next 3 to 4 years, their equity could come back. But if they don't, and they have to sell those properties this year, then from the perspective of those investors and those general partners, there's distress. So let me put
Okay.
it this way. We have distress in the multifamily market in that about 100,000 investors in about 3,000 properties might lose money.
Okay.
We have distress in the market in that 3,000 general partners that are holding on to these properties. Their properties might go back to the bank or might be sold for an equity loss. If that's your definition of distress, sure, we have it. And it's here right now. If your definition is that the multifamily industry is in distress, that's just pure nonsense.
Okay. Yeah. No, it's more of the sellers took a bridge loan when they couldn't pay the high interest rate or the insurance cap to afford it, and that's where they tried to do a capital call. They couldn't do it, and the value went down, and they're in distress in that situation.
Yeah. So I think again, it's really about how you define distress. I think this is an opportunity to pick up assets at decent prices, especially if they have assumable loans. So the only reason prices have gone down 25% is not because of a change in demand. Demand is actually phenomenal for multifamily, right? Even though we are delivering 550 to 600,000 new apartments this year, we still have positive rent growth. Even in some of the metros that have a lot of supply, we still have positive rent growth. For example, Raleigh had 0.5% month over month rent growth in the month of June, right?
Wow.
Even though it has a very large amount of supply. That's about 6% a year. That's a fantastic amount of rent growth. That people would be delighted with that. And Raleigh is a market that's delivering a large number of units. So demand is not really an issue at this point in time. Our occupancy US wide is somewhere around 94.3%. That's a very healthy number. So the issue that we've had in the last 12 months has simply been interest rates, right? Interest rates are very high, so the values are down. Well, what if you could buy at today's reduced value, but assume a loan where there's a locked-in rate from 2022 at 4%?
Okay. Yeah.
When you get that, you get the benefit of the higher rates, but not the penalty of the higher rates. The combination of those two, that's where we need to be. That we need to be assuming, loans.
Yeah, assume a lower loans at 3% or what the rate was back then in the couple of years ago.
3% is not very common, but I think that there's a lot of loans, assumable loans in the market that are in the fours, all the way to 4.99. I think those are good loans.
Okay. Anything sub 5%, you see is a good loan. Okay.
Yeah, if you're above 5%, then you're not getting as much of a benefit because the buildings that have assumable loans are usually priced higher. So once you're in the fives, you're not getting that much of a benefit.
Right, right. Okay, great. So I guess in this market, if people who are active should find good value in the pricing, 25% below the market price. And investor, that's a good time for you to come in and invest, because if you can get those deals at a lower discount, then it's a good, in a couple of years, it should be a better sell because your interest will go down. So you have more higher valuation as well too. Is that correct?
There's no doubt in my mind that if interest rates were to go down, let's say 150 basis points over the next 18 months,
Mhm.
that the value of multifamily would be higher because the value of multifamily is really tied to interest rate,
Yeah.
right? So that's why the decline in multifamily prices has been so smooth because
Yes.
rates went up, prices went down, rates go down, prices go up. That's just a natural process. It's a very, very natural process. It's not anything more complicated than that. Sometimes people are looking for something, it's like, it has to be more complicated than that. No, because of the way banks decide what is the maximum loan amount of the property is tied to interest rates. So as interest rates go up, the amount of money that a bank can lend on a property goes down. When the amount of money that the bank can lend goes down, its value goes down.
Yeah, good. Excellent, excellent. So Neil, what are you working on? You want to share with the audience? Is it something you have, is there a File 6C or you working on deal right now where you want to share?
So my company, we've done 30 plus projects, over 1,000 investors. We only do 506Cs, which essentially means we only work with accredited investors.
Mhm.
And we do about 4 or 5 projects a year. We're doing lots of different kinds of projects. We're doing pref equity deals where investors can come in and get preferential equity. That's a great position to be in today because you come in ahead of the common equity investors. We do value add deals. We just bought a property for 30 million called MTR. So it's Midtown Ridge in Chattanooga, 200 units. Very happy with that one. And so what we're doing, and that was an assumable loan, by the way.
Yeah.
So we're continuously looking to purchase. It's very difficult to make numbers work. And you might say, why? Today, they're 25% cheaper. The answer is they're only cheaper because the interest rates are higher. So you still are getting hit on the net operating income right now. And so there's only certain numbers that work, and buyers want, $500,000 more than that. So you still have this buyer seller gap. But we're trying to get 4 properties a year because we think that some of the properties that we buy now are going to end up being our best in the next 5 years.
Great, great. So if anyone wants to reach out to you, Neil, what's the best way to get a hold of you and look at some of your deals?
So my company's name is Grocapitus. So you just type these words, grocapitus.com, and hit enter into Google. If you're looking to just learn more about the data that we provide data to the industry. About 25,000 people use our data every year. We publish that at a website called Multifamily U. That's multifamily followed by the letter U.com. And if you go there, you'll see 20, 30 webinars. They're very fun, interesting, very thoughtful. And if you're an investor, I think you should educate yourself more about what's happening and what's the opportunity today. So you might want to start at multifamilyu.com.
Okay, great. Well, thank you very much, Neil, for coming on the show.
Thanks for having me. Bye-bye.